can see where the financial services and diversified investments, two very distinct strategies with all the investments there. Johan van Zyl will take us through the main investments a little bit later. But this is really what we have in those areas. On the financial service side, very much focused on asset management, insurance, specialist financial services, and also banking. And as I mentioned on the diversified investments, also very specific building blocks are on that side as well. Thanks, Refuwe. Then in terms of our top 10 investments, you would see it's very much an 80-20 principle here. You know, we've got probably very close to 50 investments in total, and you can see that 10 of our investments make up about three-quarters, very close to 80% of the fund. And then there's obviously quite a long tail that will make up the other 20 to 25% of the fund. By far the largest in the fund, obviously Rain, and then you can see the others there, and Johan will probably talk about most of those in the portfolio review from Time Bank through to Blue Spec as well. Thanks. Then the group overview, you know, some people think it's quite convoluted, but it's not really. If you look at the top left-hand corner there, obviously the ultimate holding companies are Bootu Investments, which owns about 100% of African Rainbow Capital, and on its turn then own about 55% of ARC Investments, which really consists of the ARC Fund. And the ARC Fund owns 100% of the diversified investments, 50% of ARC Emerging Market Partners on the right-hand side, and then 49.9% of financial services holdings on this side as well. If one goes to Sanlam again, we've got about 13.1% economic interest in Sanlam, and we've also announced a deal where Sanlam will take a 25% stake in our financial services subsidiary, excluding the banking side of the business, but all other, in other words, the insurance and asset management and also specialist financial services side there. We're just waiting for some of the conditions precedent to be fulfilled, and we believe if it's not the end of this month, it will be very early next month that this transaction will be finalized. Thank you. On the operating environment, obviously you know better than us how the environment's been. Trading conditions generally strained for many portfolio companies. In some cases, you know, it's like just closing a tap. No money coming in the front door, but there's a huge cost base still. But I must say that our portfolio companies really shown resilience, and hence again talking about choosing the right jockeys to run it, and they've really surprised us as to how people started to making plans to do things differently, to adapt to new situations, etc. And even though we had a mixed bag of performance, you know, some of them actually did better during lockdown, and we're very grateful for those. You know, others really had very, very tough times in the portfolio, but I think management has acted very, very quickly and surprised us as to how they, you know, right-shaped the business, where they looked at the cost containment, etc. But I think from, if I may say so, from an ARC perspective, we were very, you know, close to our companies, and where they needed cash, we were always willing to help those investee companies, you know, to go through the hard times as well. So during this time, the management response, as I said, you know, was very good. Obviously, where there were major investment projects, we had to reassess the strategy of the future. In some cases, we had to revise the targets of the business performance side because of the uncertainty, and I think that uncertainty is still there. As you know, we've had the second wave. Everyone's talking about a third wave. You know, South Africa and the Southern Hemisphere is going into winter now. You know, maybe it's even, it could be worse if we get a third wave over here. But, you know, there's been an ongoing focus on good corporate governance, and from a portfolio company's point of view, obviously the staff welfare and their well-being, you know, very, very focused on that. Many of the people actually work from home. You know, there's a coming back to the office now, but many of them are still having a dual thing between people working at home and people working at the office. Thanks, Refuwe. On the market side, you know, even though the market did quite well, I think they were quite volatile. There's also very specific sectors that did very well over the last 6 months, and especially our reporting period. International investors seem to take quite a cautious stance on South Africa. Some have exited. Obviously, interest rates came down, and that affected the risk-free rate. And that would have affected some of our valuations as well, where we use a discount rates because the risk-free rate is lower. And then we obviously add the equity risk premiums and so on to it. But then there's also very much still an unfavorable investor perception on investment holding companies. And that continues. You know, the share price discount to NAV remains substantial. You know, it is across the board. Obviously, ours, we believe, is much more substantial than many of the others. We think it's a little bit to do with perhaps our portfolio of some, let's call it startups. You know, people still see Rain as a startup. Obviously, we've got Elandsfontein, the mine on the West Coast, as a startup. We've got Time Bank as a startup, A2X as a startup. And even though there are some very nice cash-generating portfolios, I think these startups, you know, obviously can't show the cash flow, and I think investors want to see the visibility of cash flows, and we'll wait for those so-called startups to start producing cash flows. Then I think the market queries our valuation of some of our unlisted investments. You know, obviously these are not for the half year, but definitely for the full year, fully audited and valued by the auditors as well. I think we've got availability of funds for future investments, but obviously that's not that much, but we will start selling some of our portfolios as well, and portfolio companies to generate some of the cash flows in those areas as well. Some of our underlying companies, you know, going through hard times, and obviously there are potential cash calls from those portfolio companies. Also, investors are concerned about the general partner fee, and had quite a field day with that the last time around, and happy to answer any questions on that again. And then, you know, we've only been listed just short of 3 years now, and it's a relatively short private equity track record, and hopefully over time we can demonstrate that we can you know, manage this portfolio for very good returns for the investors as well.
Thank you. Just on the key highlights of financial review, we look at the INAV per share, which for the 6 months under review, it has reduced by 7.35 to 8.82, mainly as a result of the increased number of shares. We had the rights issue in October 2020, and then the similar trend we see with the IFRS NAV per share, which has decreased by 8.58% to R8.84. And then when we look at the intrinsic portfolio value, that has increased by 15.4% to 12 billion in the period under review, and that has driven mainly by the acquisitions, and part of the acquisitions were funded by the debt as indicated in the slide. And then in terms of the cash, we ended the year, which is 30 June, with a cash of 61 million. And then as at 31 December, our cash balance was sitting at 455 million. On the capital raise side, I've already touched on it. We successfully raised 750 million during the year in October. And on the performance, just the key highlights there, we've got the value of Rain increasing to by 382 million. And then also on Time Bank, the company had signed up 2.66 million customers, of which 50% were active. And then in terms of the acquisitions, we acquired 12.5% of the Sanlam third-party manager during December 2020. This is at ARC Funds Effective holding. In relation to the portfolio movement for the 6 months, our portfolio is driven by the fair value increases as well as the acquisition. So in this slide, we highlight where we started. And in terms of the increases, we had the fair value increases of 1 billion and the fair value losses of 360 million. In the subsequent slides, I'll touch on where the increases and the decreases are coming from. Then in terms of the acquisitions, we had acquisitions of 1.2 billion and the disposals of 281 million. The other movement is minor movements that comes through. And then the slide number 18, here we highlight the movements per each portfolio. The black or gray is diversified investment, and then the green is financial services. So this one as well, it mainly mimics the previous slide, but it just indicates how each portfolio has grown in the 6 months period. If you look at the financial services, they've grown from 3.4 billion by 681. This is mainly contributed by the major acquisitions that you'll see in the slides coming up. And then in terms of the other adjustments, which are mainly the fair value gains or losses, that one, our diversified investment has contributed more, while our financial services has contributed minus 88 million. And then in terms of the closing balance, you can see that our diversified closed at 8 billion, while our financial services had closed at 4 billion. And then the additions, which I've touched on in the previous slides, the major ones coming through there is the Sanlam third-party asset manager at 407, partly funded by debt, Time Bank, 252 million, and ARC Investment, 186. And then we also have Crops at 141 and Arch Emerging Market. And the disposals there that you see is the disposal relating to the Fletch capital of 270 million. And then on the next graph, we showcase the net fair value gains and where they come from. Majority come from Rain, Afrimet, and Fletch Capital, which Johan will touch on when dealing with the portfolio review. And also just looking at where our major write-downs were coming from, or fair value losses were coming from. It was Last Mile Fund, which is the coal mine that we have. Alexandra Forbes, 110 million. They're mainly driven by the subsequent or special dividends that we received. Acon Agri and the Arch Emerging Market. On the Arch Emerging Market, it was mainly driven by just the exchange rates. The cash movement slide, this one just showcases the intrinsic portfolio growth, which we've touched on. In terms of the cash, how our cash has grown and how we have utilized it. The utilization, it was mainly the investments that we have made, and the net increases included in the net increases there, you'll see that we've got the rights issue were also included in there. Just looking at the debt, I've already touched on it briefly on the first slide on the key highlights. We started the year with 1 billion and we increased by 537 million. And the net increases, it's mainly just the interest that, or the preference dividends and the interest that we accrued on that. And we ended the year on 1.6, mainly driven by the acquisitions. Other net liability movement there is the creditors that we had at the end of the year and all the movements and the accruals that we had for the 6 months period that you note them. And then on the valuation approach, this slide just indicates how we valued the investments, the method that we utilized in valuing the investments, as well as the discounts that were applied. period by period so that you can see how certain movements have been made. In terms of rain, we ended the year on the 6 months period on 3.4. AfriMet is valued on 30-day VWAP, which has increased. You see it was on 1 billion there. And then crops ended on 876, GemCap 626. And all of this will be explained in details in terms of what driven the value in the portfolio review, which Johan van Zyl will take us through.